if the equity market decline is a function of issues around private credit and fear starting to spread through the markets, I would expect the reaction function would be more immediate than if the stock market just suddenly of its own weight started to come down. I mean, given how extreme the valuations are, if the stock market lost 10% in the next week, that would be nothing. And I don't think would necessarily get Kevin Warsh off the dime. Whereas if it went down 10% in the next week because some private credit fund blew up and there was concerns like, okay, it's not just going to be down 10%. This thing could come unglued and it could be another global financial crisis. That's a different thing. So I guess it depends on what's the trigger for the equity market decline. Does NVIDIA actually not surprise on the upside and that causes the market to go down? I don't think that's the basis for cutting rates or running in with the fire hoses, but I think it would be very problematic if the market started to come unglued in September. That would be a real problem for him. The one thing that I've had as an operating framework was that whatever happened, they'd have to get gasoline prices down well in advance of the midterms because you're going to lose the affordability argument if you don't have that moving significantly lower. So if you assume that they're going to do everything, move heaven and earth to make sure oil prices and gasoline prices in particular are lower in September and October, then presumably you're setting up a backdrop that would be favorable for the markets, one would think, but anything can happen. So when you look at the overlay between gasoline prices and sentiment, it's pretty immediate. So they just need to demonstrate that prices are coming down, not this on, off, 1 week we're making a deal with Iran. No, we're going to go back to war. No, they need clarity that, okay, prices, they're going to continue to really move lower. And that would give them the confidence. If that happened at the beginning of October, it might be enough time, presuming that they actually had the conviction that, oh, okay, it's well and truly over. We can anticipate that gasoline prices are going to be back below $4 in a couple weeks, and soon they'll be $3. When he draws these parallels to the Volcker period, it sends chills down my spine and should for anyone who's consuming this interview who's invested in the markets, because the one thing that the Volcker area was not was favorable to financial assets. We had a double dip recession and 80, 81 hideous markets for equities. And of course, interest rates at massively high rates. And the concern I have with the parallel isn't just, that it implies rough sledding for the markets, but also stark difference between then and now is that you could do those things under Volcker because we weren't as enormously leveraged as we are right now. So the fact that interest rates were 20% wasn't even as big a deal as it is. Maybe at 5% on the 10-year today would be lights out for us, just because there was literally the debt to GDP ratio. That's when it started to slowly begin to creep up, was in the early 80s. As rates came down, people started to borrow more and more because borrowing became less expensive. And as rates went further and further down, debt went higher and higher and higher. And here we are with record levels of debt to GDP and corporate leverage. So it's a totally different. This is what I hate about the comparison. You're just eliding over the blaring difference. And then there's another massive difference, and that is that early 80s under Reagan, the other thing that happened was globalization. Tear down this wall, Mr. Gorbachev, turning inward globally. So basically, we had 4 decades of globalization that acted as a tailwind for these lower rates and these booming financial markets. And now we're going exactly the other direction at an accelerating rate, I might add. So I think that's another massive difference between today and that period. It was a big show of force, obviously, with all the big tech CEOs, et cetera. But it didn't seem like there was anything particularly noteworthy that came out of it. I mean, I guess I wonder to what extent they're going to be helpful in dealing with the situation with Iran more than anything, because they're obviously among the ones who are hurt the most by what's going on there in terms of their access to oil. So that conversation would have been interesting to have more insight on. And the other other thing that I had been thinking about post that meeting, Bassett had a visit in Japan. I wonder if he is trying to cobble support for our treasury market. And if he isn't, why isn't he? Because we just got the treasury capital flows in March, which was 1 month into this Iran situation. Japan sold $48 billion worth of treasuries. Their total holdings are 1.1 trillion. So it's almost half of their total holdings at an annual rate if they were to sustain that. China sold a same amount. And Turkey sold a bunch. And these are all sales that aren't necessarily to screw the US, but because they needed dollars to buy higher priced oil. I would think that Bessent's job is to try to figure out a way via swap lines or whatever to reduce this pressure on the treasury market that's associated with this Iran situation and the need to sell treasuries by these countries to keep up with the rising price of oil, because that's a major problem, or it will be. And I guess to the extent they were trying to diversify out of dollars anyway, this has accelerated that diversification into hard assets. And what we had been seeing was that they were diversifying out of dollars, not into other currencies, but into commodities, and gold especially, obviously being paramount. But I would just underscore again that they'll be rebuilding oil reserves. So I think that you'll see a shift from currency exposure to commodity exposure as a result of that. I think it's interesting the way you describe this 20% flow out of Hormuz is shifting now after the fact. It's kind of like COVID and the awakening around PPE in China. Everyone realized all of our PPE and our supply chains and everything is all in this one place, and we can't rely on that. And yeah, people are adaptive and flexible, and they will move, like you said. I guess I think of it very much the same way I think about gold. And when it went to 5,500, I felt like, wow, this went way farther, way faster than I thought it would. But I always expected it would get to 5,500 on its way to 6,000 and 6,500 and 7,000, And I guess my attitude about this is, hey, I never really thought that oil prices would go to 110 that quickly, but ultimately I think they're going back there eventually. So I'm not a trader. I'm an investor. And I guess my attitude is, yep, I'm okay to watch it come back down because I know it's going to go right back up. And I'm not clever enough to be able to time it exactly. And I mean, yes, I could sell some now and then buy it back later. But I think I'm just going to look for opportunities when it does come down to maybe get more exposure through the producers or find other new interesting ways to get invested in that space and expand my position rather than trying to reduce my current exposure. I'd rather build more exposure when the price comes down. And that latter category is extremely small, and the energy thing is not a whole lot bigger than the cash. And so it's really still very heavy on the precious metals. Yeah, I think I would definitely move from the cash. And then I guess to some extent, I might move from the bullion bucket into energy, but I wouldn't touch my minor exposure. Well, I think we will have a period where the top end of the K, if the financial markets really do stub their toe, let's say, that would come down, but that would simultaneously lower the bottom of the K as well, because it's going to throw a lot of people out of work. You'll have a period where the top comes down a lot and the bottom comes down a little. And then, of course, you'll have a lot of supports to kind of prevent the bottom of the K from going much lower. And then my long-term deep-seated optimism here that you'll get to a starting point where we kind of reset the table and you have an environment where the lower end of the K really begins to move up, and that eventually starts to push the top end of the K up again. Basically, what I'm describing is an environment where growth is led by productivity-driven growth, CapEx-driven growth in the economy, rather than by financial assets and credit-driven financialization. Let's say we go back to the world where we were actually building things, whether they be AI generated or whatever. They can be high-tech things, but where we actually have a productive economy rather than one that is producing paper claims. That is a complete monetary reset so that we are no longer have a Federal Reserve that's in a position of destroying purchasing power, which I would argue is wholly responsible. That what would have been like this, the middle class going like this. It's been the steady destruction of dollar purchasing power over decades. And so I think we need a complete monetary reset, and that will bring with it a fiscal reset. And that would all be tremendously bullish for the economy long term. It'll be extremely painful in the process. It will be a very positive thing in terms of getting us back to a real sustainable growth.